yes, you experience capital growth when it comes to property, or should be experiencing capital growth when it comes to property, but capital grows in an asset that, you know, meets your lifestyle, that you want to live in the area, and maybe families in the area, maybe kids' schools are in the area, and it's still an asset that's going to perform well. There's a lot of trade-offs that happen with it versus
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again and back in the recording studio.
Back on the wireless, Andrew.
Exactly right.
On the
On
the airwaves.
Yeah, back on the airwaves and back post budget.
Yeah, so actually that's interesting because it will have an impact on what we're going to talk about. We're talking to everybody today about rent vesting. So renting and investing versus owning a home. And we're actually going to talk about who is the actual winner in this scenario. Obviously, the budget has made some changes, so we'll address that as well too, with negative gearing and also capital gains tax as well. Andrew, let's get cracking. Let's talk about what rent vesting is.
Yeah. I mean, we've done I think one or two podcasts on it in the past, but it's been a little while. So just going back to it and looking at, okay, well, what is rent vesting? Rent vesting is when you rent the property that you want to live in, and you invest elsewhere. So normally in this scenario, we're talking about investing in property. So you're equalizing the two scenarios and saying, all right, we're going to rent where we live and buy investment property, as opposed to doing the traditional approach of, buying a property that you live in as your principal place of residence.
And I imagine this is more so driven by, I guess there's a couple of things in terms of being able to have the flexibility of renting wherever you want. And at a particular point in time, obviously your lifestyle changes, but as you're younger, you might want to be more in a city because that's where the action is and stuff like that. And then when you get a little bit older and maybe you've got some family responsibilities or commitments, you might want to move out to the burbs to have a bigger place. I guess renting gives you the ability to do that first and foremost. And then above and beyond that as well too, it's thinking and saying, okay, if I want to purchase a property to live in the area that I want, maybe just because of my financial position, I don't have the ability to do that. I can't get into that particular suburb where, say, the family home was or what have you, because I've been priced out. So it could be both of those things. It could be those things in isolation as well too. But I think that's a key differentiation, key thing to distinguish as well too.
Yeah, and I think that when you look at, rent vesting and some of the reasons why people consider it, and it's becoming something that's more and more prevalent in this day and age than maybe what it was in the past, I think that you also have the ability to just select the best investment from a property decision perspective. So rather than, you're buying a property that you want to live in, that maybe you're going to upsize in the future, or maybe you're going to sell and move, you're kind of trying to do a bit of a balancing act of both. You're trying to buy property to live in. You're trying to make sure that it also, is going to grow in value, because that's what's going to give you the ability to, expand your portfolio in the future. Versus rent vesting, you buy the best property from an investment side of things, and you live in the property that meets your lifestyle goals, and don't need to do a balancing act between both.
Yeah, and I think it's important to call out and differentiate too. Like there's an emotional bias that comes with home ownership.
Yeah.
I think it's fair to say it's still the Australian dream that everybody wants to own their own home. So that gives you security, it gives you stability, it gives you certainty, it gives you some roots to lay down to be able to raise your family. So that's still the case. But at the same time, you also need to think that in order to do that, you're sinking money in, there's less flexibility, you're locking in your lifestyle, you're trying to preempt what your needs are going to be in the future with a growing family. So yes, there may be some bias, and I think it's easier today to think about rent vesting as an alternative than what it would have been traditionally, where you follow, say, a traditional path. People are a lot more mobile these days. They're traveling a lot more. So what impact does that have? But yeah, there is some stuff that still, I think, leans towards ownership. Maybe it's just changing the thinking and going, hey, I'm still a property owner. It's just that I'm not a property owner for my owner occupier. I'm a property owner with investments.
Yeah, exactly. And so, look, naturally, people are going to have some sort of emotional bias. And I think that for a lot of people, when you start talking about, the option of this, that tends to be where it falls over. And yes, there is a percentage of people where we're having these discussions and it's something that you're actually looking at, okay, well, financially, what is the right thing to do and what's going to be best for my situation. And for a lot of the times, it doesn't even get to the financial aspect of it because, if you're the type of person that says, no, I want to live in the property that I live in and I want to be able to, renovate if I want to renovate and make changes to the property if I want to make changes, and alter that from a lifestyle perspective, then it kind of just falls over from there.
Yeah, no, you're right. Let's talk about opportunity cost and the financial reality of this too, Andrew, because it's tying up money in the form of a deposit. Yep. So what do you need in order to get in there? You might be in a position where you can borrow the rest, which will be great. But you're tying up a deposit versus taking that money and investing it elsewhere. You're looking at capital growth. So in terms of the financial reality and the opportunity cost, capital growth in an owner occupier versus capital growth in an investment property. You're talking including leveraging because you are borrowing money, the compounding aspect of it, what's going to perform in what area, in what market. When you do eventually decide to sell, is the property that you've got attracting a large number of buyers because the composite of the property. There's a lot to consider when you start to think about the financial opportunity cost and the trade-offs associated with that. And I think ultimately what it comes down to, and once again, it goes back to the emotional piece as well too, is saying, okay, if I decide path A versus path B, what will yield me a greater financial result? And is the financial result greater in one instance versus the other? As an example, is it greater in rent vesting versus buying an owner occupier? And is the mathematical part of the equation, the financial gain that I'm going to experience, is that great enough to then be able to say, yes, this is something that I'm prepared to pursue as a strategy. And that's the direction, the path that I'm going to go down, because there's obviously a timingness to this as well too, because if you go down the wrong pathway for you, you don't want to be going down that pathway too long before you correct course.
Yeah. And I think that when you start to consider the financial reality of it, I think that some of the things that can get missed when you are looking at the impact of rent vesting versus buying an owner-occupied property is that when you are rent vesting, yes, there's the tax treatment, which we'll talk through, which is one of the main attractions towards having an investment as opposed to an owner-occupied property, or potentially in the reverse when you're talking about capital gains on the 0% capital gains for a PPR versus capital gains on an investment property. But you also need to consider, and you can't do this with any certainty because it is an estimation, but what is the capital growth? So when I'm comparing that, it's not as simple as same capital growth rate and one is at a 0% tax and the other one is at a marginal rate of tax, either with a 50% discount or indexation with obviously the changes in the budget. But what greater level of capital growth can I get if I'm selecting the property purely for investment purposes and not taking into consideration any lifestyle? Because the reality is that, yes, you experience capital growth when it comes to property, or should be experiencing capital growth when it comes to property, but capital growth in an asset that, meets your lifestyle, that you want to live in the area and maybe families in the area, maybe kids' schools are in the area, and it's still an asset that's going to perform well. There's a lot of trade-offs that happen with it versus I don't actually care about whether I like the area or not, or whether I've got, proximity towards family and friends and support networks and all of that stuff. I just need it to grow in value. So you can achieve a higher rate of growth when you don't have to balance out all of the other things that you need to when you're talking about owner-occupied property.
Yeah. Cash flow. Obviously, cash flow difference is very, very substantial here. And I guess the whole rent vesting will. Yeah, and the rent vesting, I guess, theory and methodologies is, and let's use some round numbers here, right? But, you might be saying, okay, I'm going to purchase an owner occupier and it's going to cost me, as an example, $5,000 a month in order to service. And I'm going to go down the investing pathway and rent vest. I'm going to rent a place for $2,500. I'm then going to purchase the property. I'm going to be out of pocket. I'm getting rental income coming in, and looking at the difference between those two from a cash flow perspective. And, we can't obviously go through numbers here because we don't know what a property is going to yield or what the, rate of return or the interest rate is going to be. But you then say, okay, from a cash flow perspective, what does that look like? From a taxable point of view, negative gearing, what does that look like? Obviously, the budget's impacting that. Hopefully not. Hopefully they unwind it or water it down or what have you. And then above and beyond that, it's the capital growth that you can expect. And at the end of a period of time, does that justify the strategy from a financial aspect? And then along the way, I can live in a property that I want to from that perspective. And you're looking at things like, principal and interest repayments on your mortgage. You've obviously got rates. You've got maintenance associated with that. And that one can't be understated because maintenance and trips to Bunnings do get expensive. Even if you've got a property that is set and turnkey and all ready to rock and roll, it does get a little bit more expensive. I mean, rent vesting, the rent, it's, depending on where you're getting, you've got a large degree of control over how much you spend because you know what the number is and it's capped. That's it. You're renting and the price is, $2,500, $3,000 a month. That's what it is. You know that it's not going to be a little bit more because the hot water's blown up and bits and pieces. And then obviously from a loan perspective, you're paying a higher interest rate, generally speaking, on an investment loan. There's tax deductibility associated with it as the law currently stands. And then depending if you want to massage that even further from a cash flow perspective as well too, as an investor, you might opt for an interest-only loan rather than a principal and interest loan. So you need less cash flow to be able to do that strategy. However, in saying that, it's such a big part that getting the cash flow modeling right associated with this strategy is critical because you want to know what you're looking at before you pull the trigger on.
Yeah, and you need to factor in some of the things like, land tax. You're paying land tax when you're starting to talk about owning an investment property versus an owner-occupied property. You need to and know what you're solving for. So when you're talking about rent vesting, it's what is it that you're trying to achieve? So are you trying to achieve the best financial outcome, or are you trying to give yourself the greatest degree of flexibility in order to be able to have, more cash flow to be able to enjoy your lifestyle currently out to a greater extent? And different goals are going to mean that you should be structuring things differently. And what I mean by that is, let's say you put everything in and say, okay, it's going to cost me $6,000 a month to own a property that I live in, versus it's going to cost me $4,500 a month, all in costs for rent vesting and owning an investment property. Now, under that scenario, you might say, okay, great. Well, rent vesting is the key. That's what I'm going for. But what is it that you're trying to achieve? Because if you're talking about $6,000 a month and your property is going to be worth $1.2 million and you may, potentially upgrade that property in the future, well, that's very different to having a cash flow implication of $4,500 a month, but you purchased an investment property that's only worth $650,000. And now all of a sudden, even if they grow at the same rate, or even if the investment property grows to a larger extent, it's having less of an impact to your wealth creation.
Yep.
And all of a sudden, yes, you're saving $1,500 a month. What are you doing with it?
Yeah.
Are you investing that $1,500 a month, or is that just going on frivolous spending, and all of a sudden that, is just being factored into your lifestyle and you're not actually getting any real tangible benefit for it? So understand what it is that you're trying to solve for. Is it cash flow? Is it flexibility? Is it maximizing my wealth? Is it a combination of two of those and, less of the other? But what your optimum strategy is going to be is dependent on what you're trying to achieve at the end of it.
Yeah. And interesting that you should mention that around investing the difference of doing something with it. And a lot of the time we see that property is a really good mechanism because it works like forced savings.
Yeah.
So if you go down the rentvesting path and saying $1,500 is your number, right? So that 1,500 you need to invest it and do something with it. You have to have that discipline each and every month in order to do that. So there's it's not as forced as what a mortgage property would be where the repayments are higher. There does take a little bit of discipline to it as well too. But just elaborating on what you were talking about in terms of your goal, Andrew, and what it is that you're trying to achieve. One of the things that can't be understated is the tax treatment of both of these assets. Now, obviously, we've had some changes that have been proposed in the budget, and I'm saying that they've been proposed with the hope that, there's a chance that they may get watered down, but I doubt it as well too. So that's just so people are hearing that and understanding what I'm talking about. But obviously, owner-occupied property, exempt from capital gains tax when you do sell it, right? So that's something to take into consideration. At the same time, any debt that you're servicing on that property, you're not able to claim the debt as deductible, like from a negative gearing perspective. Old world, not new. When you think about an investment property, you've obviously got things like capital gains tax, and that methodology has changed now. So we're looking at that going, okay, what does it really look like when you model this out? You own an asset for X amount of period of time. You make some assumptions over growth. What's the tax that you're going to pay? And one of my favorite sayings is the juice worth the squeeze. So that'll be an interesting calculation to do. If it's a new property, the tax deductibility is still there from a negative gearing aspect. If it's an established property, then that negative gearing is out the window, so that's gone. So that changes the makeup of it as well too. And then from a capital gains tax perspective, the CGT, from a taxable gains perspective, that's changed as well too in the budget from that perspective. So a few things to take into consideration, because the tax treatment will then change your strategy. And it's quite interesting because we always say that tax shouldn't be your driving motivation in terms of getting into a particular investment or a particular strategy. However, in saying that, it's playing a bigger and bigger role now because of the environment that we're in and the environment that we're facing with these budget changes.
Yeah, and I think that whether you're someone that's been considering rent vesting or whether you're someone who is already rent vesting, re-looking at it now and saying, okay, well, the goalposts have now shifted and the environment has now changed, and it hasn't impacted your owner-occupied properties. And so to that degree, there's no change that's ultimately happened there. And what it has done is it's squeezed investment properties and reduced some of the net benefit that you're getting from an investment property side of things. And now all of a sudden, you do need to relook at your calculations and say, okay, well, if I was doing this for financial benefit, is it now worth it? As you say, is the juice worth the squeeze? And you can't necessarily predict this with any form of certainty, but now that the goalposts have shifted, and they haven't shifted previously for a very long time, what does that mean for potential future change? So we talk about risk, we talk about, yes, this is the right decision now, but needing to pivot and paying stamp duty is really the big thing, right? Like if you need to pivot and all of a sudden you're selling an investment property to buy an occupied property, there's capital gains implications, there's stamp duty implications. And so you want to be able to preempt as much as you can. Some things you just won't be able to. But knowing that the government has now tweaked tax on investment properties and they've disguised it as trying to provide more opportunities for, first-time buyers, which is not going to have any impact whatsoever, just so they're not clear. But now that they have started to play with those rules, is there now a greater level of risk that's associated with, going down the route of rent vesting, in that if those rules have already been tampered with, what's the likelihood the future governments are now going to tamper that again in the future and, dip their hand into the cookie jar and try and pull some extra tax from property investors?
Yeah, I think the answer to that is almost certain. Until the government can learn how to get the spending and the budget under control, they're going to be under constant pressure to do that.
Yeah. And I know that we're taking a different tangent in this, but it's relevant to the topic. trying to solve a government spending problem by taxing the population more is like trying to solve a drug addict's problem by giving them more drugs. Anyway.
I like it, Andrew. Mic drop. Mic drop. So, Andrew, I feel like we've gone around not around in circles, but we've gone around the grounds here with this. So who's the winner?
The winner is the person that actually looks at their own situation and looks at their own strategy. There is no universal, you should be rent vesting or you should be buying an owner-occupied property. It's the person that is making an active decision as opposed to either, hey, rent vesting sounds like this really cool thing that everyone's talking about and I should go down that route. Or, hey, my parents and grandparents have always done this in a particular way, I'm going to go down that route. It's, okay, well, what is the right thing for me? Mm-hmm. What's the right thing for my family? And if it was the right thing, 2 years ago, is it still the right thing now, or do we need to pivot and change direction? So understanding, okay, what are my goals? What am I trying to achieve in this situation? What are some of the likely things that I can factor in that, I know that for argument's sake, I want to have kids and I want to upsize the family home. Maybe rent vesting for a period of time makes sense. And then you move into an occupied property until you could build some equity and buy something that's of larger value. Like, build a strategy based off your circumstances and your goals.
Yeah. And I tend to think that, in terms of reflecting on my own personal circumstances, that at different points in time, a different strategy would have made sense. Like now, obviously, I've got children. They're older. They're established in school. All of that sort of stuff. I kind of like the idea that I'm in an area. I own my own house. The bank owns it anyway. But I've got my own house. I know that we're not going to get uprooted because the owner of the property wants to sell it and what have you. So that gives me a degree of comfort. Whereas when I was younger, maybe pre-kids and things like that, I'd want to be in a different area, different lifestyle. And I wouldn't mind necessarily if I needed to move because the landlord or the owner wanted to sell it. So I think different points in time definitely do make a difference. But ultimately, the thing that I got out of that, Andrew, is that there's no right or wrong strategy. Rent vesting or owning, not right or wrong. I think because it's unique and it's different for everybody. But doing either without a plan, that's the wrong thing. Doing either without a strategy and thinking through it, that's definitely the wrong thing.
And that's the mic drop.
That's it. No, I think yours was. I definitely think yours was better, Andrew, for sure. Andrew, thanks for today.
Wills, thanks again for another great podcast. I hope the listeners and viewers got a whole heap of value out of that one. If you did, like, subscribe, and we look forward to catching you on the next podcast. Thanks, Wills.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.